I'm Peter White. Welcome to the Inside Network. Welcome to INDepth. I'm Peter White, and my guest today is Jun Bei Liu from Tribeca Alpha Plus Fund. Welcome, Jun Bei.
Thank you.
You've had an impressive and long career, and you're interested in public speaking. Can you just talk through your role at Tribeca?
Absolutely. I manage a fund called Tribeca Alpha Plus, and the fund size is about $800 million. Now, what's unique about this fund is that it has both long and short, which means we take advantage of rising, falling market or rising, falling share prices. So it's been an incredible success story with this fund. It's been around for over 10 years, and then we continue to grow with this fund.
What about the pandemic? How has that affected your operations? And are you taking more long positions or short positions because of the pandemic, or it's not affecting that?
Short position always helped during a market sell-off, so that helped us during March. But what we really saw during that period was significant amount of opportunities. Some of those opportunities we saw was once in a decade, probably not century, but once in a decade buying opportunities. And that's what we did. We took on more risk, and we saw those companies that trading at a fraction of their real value, high quality companies with good cash flow, and we took advantage of the falling share prices. At the same time, we manage our risk through some shorting other businesses. So we actually came through that period really well, and we delivered significant amount of performance compared to the index, what index delivered that period.
What sort of, can you give us a few examples of the companies that you pounced on?
Of course, there are many. So one of the biggest success story, I guess, is Afterpay. We increase our exposure. We'll continue to buy by end of March, simply because we noticed the share price was really collapsing on the basis that there was no buyer, and people were fearing about how things might turn out and the like. And our view of the business is that it has a highly efficient capital structure, turnover really fast, and if there is any default issues or problem with the customer base, they can switch it off very quickly. So on those bases, we took advantage of it. We took a large position, and since the share price has gone pretty much gone from $8, that was the base it touched in March, to now over $100, $103 it touched the other day. So that's been an incredible performer for us. There's others. We took advantage of some of the retailers that were sold out because their shops has been forced to shut down. We bought them in April, and since then, because of the government stimulus, because of the JobKeeper, a lot of those, we've seen the share price doubling, and that has delivered a lot of return to us. There's more, so we have our performance over our performance relative to the benchmark was really because we took advantage of the sell-off. We were not fearful because based on understanding those businesses, we know it will come back, and just took a little bit longer term view compared to some of other investors that fixated on the short term earnings.
Of course, volatility has been the hallmark of this year, 2020. How do you manage the risks associated with volatility when you're looking at your asset allocation?
Absolutely. You're absolutely spot on about the volatility and the risks. One great thing about long-short fund is that we can short businesses that has weak earnings. And some of those businesses may be trading on very expensive multiples, but we can take advantage of that by shorting it and betting on the share price will fall. At the same time, what it does is that give us the opportunity to buy some of those business. They may be expensive, but they have a huge total addressable market, and then continue to expand those horizons. So with those bases that we have come through this period very well, and continue to manage our risks, at the same time buying and selling businesses that will deliver to the earnings expectations or missed expectations.
Can you talk us through how you approach the quantitative analysis versus fundamental analysis, how the two interplay in the management and the asset allocation that you undertake?
I think sometimes people spend too much time thinking about how different they are, and all of that. But eventually, they are the same thing. So fundamentally, as a fundamental investor, which that's how I was brought up, how I was trained over many years, is that you look for good quality companies. You look for good cash flow, good revenue growth, good customer gain, a good team of executives that continue to deliver, have that consistency, track record. You look for a company that don't disappoint as much. They outperform outperform the expectations. They do all these things, has good balance sheet, has all of that. So a fundamental investor will constantly be scouring the market for that. But one downside of the fundamental investor is that there's only so much time we have. We, at any point in time, we have high conviction on, 15, 20 stocks. Whereas what the quantitative tool does is that it's a tool. It's a great tool. It does the same thing, but just across a huge range of stock, and get that understanding and snapshot of what they look like to start with. By combining both, is that you have the great in-depth analysis and understanding of companies. At the same time, you have a snapshot across the market. You understand where that company sits against its peers and others. Just much more holistic when you're looking at investment this way. I don't see them as very different investment process, but they just much more holistic, and it's better than one side or another.
In effect, complementary.
That's right, very complementary.
Now, in striving to achieve your rates of return, you have a 140-40 protocol. Can you talk us through that and how the short and the long interplays?
Of course. So 140 or 150-50 is essentially we hold long position, which is the stock we buy, 150% of our portfolio, and then we short the 50% of that group. So at any point in time, we hold about 100 stocks, and we short about 30 of them, and then we long about 70 of them. So the percentage, what that means is that if we have conviction in the market, we can increase our gross exposure. So 140-40 or 150-50, it means 200%. So if I have conviction that certain stock will fall, I will increase my short exposure, funded by, or using that money I shorted that stock with, invest in the company, I think it's going to go higher. So a lot of times when we see that kind of conviction, we invest more. And that's how we generate a lot of our return, by leveraging to the upside and the downside of both ends of the spectrum.
Some observers would think, well, this is quite a high risk approach to funds management. What do you say to those sorts of people? Yeah,
it's a misunderstanding. It's actually not true at all. Often when people think about shorting and everything, they think quite risky. But if you look at the sort of risk we track, our tracking error is usually tracking between 5 and 6%. You look at a lot of other funds, long-only funds, their tracking error is actually significantly higher than this. And on our risk-adjusted return, which is in terms of volatility, we actually deliver very high return per unit of risk. So our fund actually has been consistently delivering return, whether it's in the up market or down market, thanks to our process and our ability to long and short at the same time to lower the risk. So actually, let's put that in an example. We love Afterpay. We talked about Afterpay before, and we generated a lot of return for our investment from investing Afterpay. But investment in that Afterpay, it exposes us to a lot of risks, such as NASDAQ risk, such as market volatility risk. So if NASDAQ tomorrow fall 10%, Afterpay will fall much more than that, simply because it's a very risky stock and it is on the expensive side of the spectrum. So what do? We short another tech company that has earnings problems, that has consistently disappointed, and that we believe that don't really have the ultimate addressable market, and it's also expensive. So by shorting that, I actually reduced my risk in investing in Afterpay. So when markets suddenly have a sell-off like they did in March, we can still outperform because of that.
Let's turn to ESG. How do you integrate that into your portfolio, and has it affected your returns?
Look, we increasingly incorporating more of the ESG process into our investment thesis, really. We started taking more structural view on some of the assets that will have structural ESG issues. We have found that has delivered us quite a lot of return by having those structural shorts. These are the assets, I won't go into specific, but these are the assets that will really struggle for new investors in the future, particularly institutional investors, just because their effect on the environment and the like. Now, some of the other ESG issues, in more recently we've been hearing about is more about governance and the like. So we started taking quite a proactive approach in looking at some of those issues. We regularly involve or engage with the chairperson with a lot of those businesses, perhaps twice a year. And also we're quite active in looking at some of those resolutions and engage with the company when we do disagree with some of those issues. And we do believe this is the way the future will look like.
It's been said by many that the G, the governance, is the critical issue of those three initials. What do you think about that?
Absolutely. Look, I think governance is what sets the tone. When they look at the responsibility of the board, you set the tone of the business, and you set the tone for the culture. You set the tone for pretty much how everything else will flow through. Financial metrics will come later if you hire the right executive with the right culture, and with the right aspiration and discipline. And then the financial metric will follow. So that is incredibly important these days, especially where we hearing more of the not so much scandal, but more of the issues that's arising from some of the larger company boards. So to us it's very, very important.
Now, are your short positions more important than ever in this period of low interest rates?
I think it's more important than ever because of the volatility in the marketplace. It helps to manage the risks. Now, low interest rate, it gives us the opportunity to find assets that offers that structural growth opportunity, and also at the same time, I guess in a way, we can use the short to hedge the possible risk of real bond yield potentially will rise at some point. Not yet happening, but perhaps in 2020 we might actually see a little bit of tick up in inflation, and the actual interest rate won't rise, but we will see some of the movement. So share market try to look through that. Share market tend to move way ahead of that. So what we do is that we manage our exposure to whether it's growth, whether it's value, and hopefully to deliver a very consistent return to investors.
Yeah, so the low interest rates aren't critical to your shorting strategy, or they're not turbocharging it? Or?
I think that with the low interest rates, what my fund, what's the advantage of a long-short fund is really compared to a low interest rate is that we can deliver higher return. In a low interest rate environment, investors are incredibly difficult to get returns. If you invest with a long-only manager, it's actually quite difficult to beat the index without the ability to short. And so what we have found is consistently, if you look at the survey for Aussie managers, the funds that can do long short generally consistently have been outperforming the entire long only spectrum. So for us, it's pretty clear cut, and we consistently deliver to the top end of that long short managers as well. So low interest rate environment, you want to be in more active strategies such as this one.
And so in fact, low interest rates make your fund look more attractive than ever, really.
Absolutely, yeah.
Jun Bei, thank you for talking to us today.
Thank you very much.